Hello, everyone, and welcome to tonight's edition of Women and Money Montreal. My name is Lynn Sock. Thank you all for coming this evening. For those of you who are attending for the first time, I always like to start with a little bit of a recap of who I am and what Money in Montreal is. For those who are attending for the first time from meetup.com or even Facebook, Women in Money Montreal began back in 2020, so almost 4 years ago, as a way for us to get together and increase our level of financial literacy. So these sessions, tonight is actually our 119th session. I started offering these weekly sessions in order to teach women about personal finance, investing, and entrepreneurship, as well as real estate. So we host 2 webinars a week. One is on Tuesday evening, 7 p.m., where we go over, like I said, personal finance, investing, or real estate, as well as the Breakfast Club for Women Entrepreneurs, which is every Friday at 10 a.m. If you haven't already joined the Facebook group, please do so on Facebook. You could also go to my website and subscribe to our newsletter. My website's linsock.ca. We have a weekly newsletter where I kind of summarize what we've learned over the last week, as well as I provide some insight on some of money news, as well as mortgage news, which I publish every week. And you could find out what's going on in the upcoming week in terms of webinars, so you're never left out. I am an independent financial security advisor and founder of Linsock Service Financier. I've been in the industry for 20 years, and I'm very passionate about teaching and educating women about money. I'm not the type of advisor who just says, here, sign here, and hope for the best. I do spend a lot of time educating, which is why I started Women and Money Montreal in the first place. So tonight is actually the third part of a 4-part series on investing basics. It started off with what I thought would have been one session where I crammed everything into that session. Turns out it was a lot of information. So we spread it out over 4 weeks. So tonight, I'm just going to go over 20 terms, financial terms. I'm going to simplify them. So our topic tonight is common financial jargon simplified. And I'm going to go over the top 20. If you've attended the last 2 sessions, some of the terms I've already went over, but from experience, when it comes to financial literacy and just learning in general, especially when it's a topic that you're not too familiar with, and especially with things like investing, sometimes it takes many times for you to kind of wrap your head around terms. So we're going to spend about the next hour going over these terms. If you have any comments or questions, or if I'm going too quickly, there's the comments box. I'll be checking that frequently, so feel free to ask at any time if I'm going too fast or if you need a little bit of clarification. For those who have investment experience and are attending, this is actually very much investing basics, investing 101. So some of the material that I'm covering might be a little bit too easy or basic for you. And for the rest of you, I'm happy that you're here, and I'm going to jump right into it. So like I said, we're going to go over 20 of the most common terms in finance and specifically in investing that you've probably already heard of, but might not understand, maybe too shy to ask, or maybe you tried Googling it and you're still not wrapping your head around it. So hopefully I'll be able to give you some insight and help you understand what these terms mean. And I'm not going in any particular order, by the way. So I'm going to start off with number 1, stocks or shares or equities. These 3 terms are interchangeable. I'm sure all of us have heard the term stocks or shares in the past. And what does it mean to own stock or own shares or own equity in a company? It basically means that you own a portion of a publicly traded company. Yes, you could also own a portion of a private company, but for just to make things easier in terms of investing basics, in this sense, basically you own a portion of a publicly traded company. A publicly traded company is a company that is listed on a stock market or a stock exchange. If you are invested in a company, if you own stock or shares or equities in a company. If that company does well, the value of your stock goes up. If it doesn't do well, then the value of your stock goes down. Like I said, if you have any questions, please feel free to put them in the chat. So stocks are one of the most common type of investments. They're riskier and they're at different risk levels. The other most common type of investments are bonds. So a bond is basically a loan that you as an investor, so me as an investor, would give to a company or a government. And basically the company or the government, the government department is promising to pay you back in intervals with interest, and then at maturity it will return your capital. In general, they're seen as less risky than stocks, but because they're less risky, they often have lower returns. Now, mind you, depending on who you're loaning to, depending on which company or what type of government or which country you're loaning money to, just like with people, companies and governments have credit ratings. So Canada, as an example, has a AAA credit rating. They have never, ever missed an interest payment or any type of payments. So if you, as an investor, anyone here, if you are loaning the Canadian government money, and you're investing in Canada, if you're investing in some type of Canadian federal government bond, the likelihood of you receiving interest and receiving your capital is very, very high. We're not allowed to say that it's guaranteed because it's never guaranteed, but it's just like if you personally were to loan somebody money, for the most part, you know the likelihood of you getting that money back. And chances are, if you have any doubts that the person you're loaning money to isn't going to pay you back, you probably wouldn't lend them the money. Now, that same person, if they said to you, hey, can you loan me some money and I'll pay you back with 20% interest? That might intrigue you a bit. But again, it goes back to that question. Okay, if I loan this person, if I loan this government's money, and yes, they are trying to wheel me in with a higher interest rate, what is the likelihood that they're going to pay me back? So bonds in general are loans that us as investors that we give to companies or governments, and they promise to pay you back interest over time. And you'll receive your capital at maturity. There are different risk levels. With Canada, again, has a AAA rating. Can't say that you're guaranteed to get your interest back, but they have never, ever, ever missed an interest payment. So it's pretty safe. Next. Why can't I do the stocks, bonds? All right, next, oops, sorry about that. Next is the stock market. I had mentioned it in number one. So stock markets or stock exchanges, same thing. You might have heard, you've probably heard both terms. And they're literally like markets or grocery stores where stocks are bought and sold. So here in Canada, the biggest stock exchange or stock market is the Toronto Stock Exchange. So publicly traded companies here in Canada, it's kind of like the Costco of the grocery world. You want to get listed on the Toronto Stock Exchange so that people, regular investors like you and I, or institutions will come and buy and sell shares of your company. In the US, the biggest stock markets or stock exchanges are the New York Stock Exchange as well as the NASDAQ stock exchange. There are, by the way, other stock exchanges, but I'm just naming the biggest ones. And they are literally where people, where investors, whether they're people or they're institutions, they buy and sell shares of publicly traded companies. Now we talked about stock markets. Now let's talk a little bit about stock market index. It's basically, a stock market index is basically a measurement of a group of particular stocks, usually from a particular sector, and it tracks how they perform. So it's basically the report card of a basket of stocks. The most popular stock market indices are the Dow Jones Industrial Average, which you may have heard about. And if you follow me on Instagram or on LinkedIn, I have posted about how markets are doing well and index funds are doing well since Donald Trump was elected, actually a week ago as president-elect in the U.S. Markets have done extremely well. Overall, you have to remember that even though they've done well, this is just a short period of time during your entire investment career. So the Dow Jones is one of the most popular stock market indices. So basically, it's a basket of companies, 30 of the biggest companies in the US, and it tracks how those companies perform. So if this basket of companies does really well and you're invested in the stock market index, then your returns go up as well. If that basket of companies doesn't do well, then the returns on your investment don't do well as well. There's also the S&P 500, which is basically invested and tracks the performance of the Fortune 500 companies in the US. Also in the US, we have the NASDAQ as a stock market index. There's the NASDAQ stock market, where you buy and sell shares of companies listed on the NASDAQ. And then there's also the stock market index, which tracks the performance of a basket of the companies that are listed on the stock market, on the NASDAQ stock market. Here in Canada, we have the TSX S&P, which is basically the biggest companies, the highest performing companies on the Toronto Stock Exchange. If they do well, so do your investments. And I'm going to get into index funds a little bit later. Next, we have dividends. So what is a dividend? It's basically when a company does well and they are a company that issues dividends, they share some of the profits with its shareholders. So you might work for a company that offers some type of profit sharing plan. It's the same idea. When the company does well, they will share that profit with its shareholders. Not all companies issue dividends. Those that do issue companies tend to be those that are well established. As an example, here in Canada, banks, the big five banks, they all issue dividends and they all make their dividend payments to their shareholders. If you look at the US, the big companies issue dividends, but not all of them. Those companies that are high performing and do really well and are really established and don't issue dividends, basically what they do is they reinvest their profits back into the company. And the idea is that instead of paying out dividends to their shareholders, they're reinvesting their profits into the company so that their share price grows. So this is basically the strategic plan of a company. Companies could do either or. A lot of tech companies, even though well established, like the Amazons, like the Teslas, even though they have cash flow, a lot of them are highly leveraged. So instead of promising to issue out dividends, what they would rather do is reinvest their company and in hopes that their share price goes up exponentially. Sometimes people will choose as well to invest in dividend funds, which is basically a basket of companies that issue dividends. Next, we have mutual funds. So mutual funds are basically a basket of different types of investments, and they're literally thousands of different types of mutual funds at varying risks. So generally speaking, mutual funds mainly come with stocks, so shares in companies, as well as bonds and some other assets. And they come with different ingredients in them. You could kind of compare them to pizza. So pizza is pizza. We all know what pizza looks like, but there are different types of pizza. So think of mutual funds as pizza, but there are different types of pizzas. So you might have a pizza that's heavily invested in meat, as an example, whereas another type of pizza, it's more vegetarian. Or you could have something that's all dressed, which is a little bit of both. Mutual funds come in varying types of risk levels, as well as with different types of ingredients. Some are riskier than others. So you might have heard that mutual funds are very risky. That's not necessarily true. It really boils down to what type of mutual fund or mutual funds you're interested in. There are also mutual funds that are a lot less conservative because they might be leaning more towards bond funds or funds that are more conservative, less risky. I'm just going to check in the comments if there are any questions. No, we're good. Okay. Along with mutual funds, like I said, they're a combination of usually different stocks, different bonds, sometimes other types of investments, and the risk level varies from one mutual fund to another. So you really have to check the ingredients inside a mutual fund to see how it performs and how risky it is, and if it matches what your investment objectives are. Mutual funds are only available through advisors. There are also funds called segregated funds. Segregated funds are very similar to mutual funds, except they're only offered by advisors under a life insurance umbrella. As an example, I'm an independent financial security advisor, so licensed here in Quebec. I used to be mutual funds licensed. I let that go at the end of 2021 because it didn't serve the type of clientele that I service anymore. So now if I'm working with clients for their investments, I'm going to offer segregated funds. Very similar to mutual funds once again, but they're offered their investment funds under a life insurance umbrella. Next, we have ETFs, which stand for exchange traded funds. So I think I mentioned this last week. Exchange traded funds were created, if I'm not mistaken, in 2009. And basically, they were created to compete with mutual funds. So prior to ETFs, basically, if you wanted to invest in funds, so I'm not talking about picking and choosing individual stocks. If you wanted to invest in funds, the only way to do so would be through an advisor. We all have different titles, but you would need to go through some type of financial advisor. Then came the movement of do-it-yourself investing, and then came the movement of, stop paying an advisor fees when you could do it on your own. And thus, exchange-traded funds were created. Exchange-traded funds come in many different forms, many different risk levels, many different levels of return. And basically, the idea is instead of you working with an advisor, you could buy and sell ETFs, funds on your own through a self-directed investing platform. Self-directed investing platforms have existed for many, 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 many years. But in the last 7-8 years or so, they've become more and more popular as the marketing has become stronger and the push to go away from advisors is more and more prevalent, especially on social media. When people ask me, usually people ask me two questions. Number one, am I afraid of self-directed platforms and investments like ETFs? Am I afraid that they're going to take away from my work? No, I'm not. Maybe other advisors are. I give people the same advice across the board. ETFs were created to compete against advisors offering mutual funds or investment funds. I have a rule of thumb. Nobody who's investing, nobody who's trying to put more money aside and make it grow, nobody should be blindly giving their hard-earned money to an advisor to manage, and nobody should be giving their hard-earned money blindly to a platform to manage through its algorithm. Anybody who invests money should have a general idea of what they're investing in and and expect a certain type of return when they invest. Either or, whichever way you decide to go. If you do it blindly, I don't advise that at all, because everything is fine. When your investments are doing fine, everything is okay. The issue comes when your investments aren't doing well, or you're not understanding what's going on with your investments, or you're not understanding why you're being penalized or why you're being taxed, or why you're being charged to, let's say, make a withdrawal. This is where the complications come in. when everything is fine, and this is a general life rule, this is a general rule of life. When things are going well, and nobody asks questions. We only start asking questions when things don't make sense, or when things don't go as planned. So if you are someone who does self-directed investing on your own, that's great. Make sure you know what you're invested in, and don't just rely on the algorithm. If you are someone who works with an advisor, it's the same idea. You shouldn't blindly be passing over your hard-earned money to, whether it's a financial security advisor, a financial planner, a portfolio manager. You shouldn't blindly be giving that money to someone, because again, when your returns are doing well, markets are doing well right now, so nobody's going to complain. It's when things aren't going so well, that's when you're going to start asking questions. So ETFs, like I said, were created to compete against advisors. I don't see it as competition. It's just what it is. It's another tool for people to invest their money. Just when you do invest, have a general idea of what you're investing in, so that there's a certain expectation, and make sure that you're being serviced. You get what you pay for, to a certain extent. There are advisors who do make money off of you, but they don't deserve that money because they don't service you. So just remember that. We work really hard for our money, so make sure you get your value for your buck. So that's ETFs. Next, we have index funds. So earlier, I mentioned stock market indices. So I mentioned the biggest ones, which are the Dow Jones, the S&P 500, the NASDAQ, and here we have the TSX. All index funds are investment funds that basically mimic or follow the performance of a stock market index. So if we take the S&P 500 index as an example, some of us here, or some of you here, might already be invested in index funds, but might not know it. So an S&P 500 index fund is a fund that basically performs the same way or mimics the performance of the S&P 500, so the Fortune 500 companies. Index funds, by the way, could be found in the form of mutual funds, or it can be found in the form of ETFs. So you could invest in index funds on your own through self-directed platforms by investing in an ETF that's an index fund. You could also, if you work with an advisor, you might be invested in an index fund through one of the mutual funds that your advisor has offered to you. And again, index fund is just a simple way. There's nothing fancy to it. If you're invested in index funds, you're basically invested in a stock market index. How will you know? You could check the fund fact. If you look at your investments, you'll see the name of your investment. If you don't know where to find the original fund fact sheet that explains what you're invested in, literally take the name of the fund, copy paste it, plug it into Google, and you'll find a copy of the fund fact. The fund fact is the sheet that explains exactly what you're invested in. Oops. Oh, no, I have more. Sorry, 1 second. Technical difficulties. Again, if you have any questions, please feel free to ask in the chat. I didn't see any questions, so hopefully I'm explaining everything clearly, but please don't be shy to ask questions in the chat. So ETFs, index funds. Next, we have asset allocation. Asset allocation is basically, how could I say this? It's how your money is invested across different types of investments. Basically, your asset allocation looks into risk versus return and how your money's invested. Are you invested mainly in stocks? Are you invested mainly in bonds? Are you invested mainly in real estate? So your asset allocation is how your money in the pie is invested. You could look at this in terms of your actual investment funds. So maybe you're invested in a mutual fund. Like I said earlier, mutual funds come in many, many different forms and many, many different risk levels. But if you look at the actual fund, what's the asset allocation of the fund? Is if you look at the pie, so if you look at the fund fact of a mutual fund, you'll probably see a picture of a pie. And in that pie, do you see that a big chunk of it is invested in equities. Equities, like I said in the beginning, equities are, the word equity is interchangeable with stocks or shares. So are you invested mainly in the stock market? And which stock market? Is it Canadian funds? Is it US funds? Is it a combination of both? So the asset allocation is where and how is your money distributed? Are your investments distributed? How and where is your money invested? And you could find this information on, if you're invested in any type of investment funds, you could find this information on your fund fact sheets. And again, just to repeat, and sorry, I keep repeating this over and over. It's just, again, sometimes we need to hear it 10 times before it finally registers. If you want to know how your funds are invested, and you can't find the fund fact sheet, just literally copy paste the name of the funds that you're invested in, what appears on your statements, and you could put it into Google, and usually in the top 3 you'll find the fund fact sheet that gives you the ingredients of the fund that you're invested in. Next, we have diversification. Take this word with a grain of salt. It's important to stay diversified when you're investing, but there's also, I don't want to call it over diversification. Sometimes there's an illusion of diversification. So more often than not, again, when I meet with new clients who have completely trusted an advisor, or they completely trusted the algorithm on a self-directed platform, if I ask them, are you diversified? They'll probably tell me yes. But when I actually check the funds or whatever it is that they're invested in, they're not really diversified. It's just when you take a look at the statements, you'll see the names of all kinds of different types of funds, but they're all the same ingredients that are in it. So diversification, it's important to stay diversified, but check your investments, check your statements to see if you actually are diversified or if there's an illusion of diversification. So diversification basically means that you're spreading your investments. You're not putting all your eggs in one basket. You're spreading your investments over different types of assets, different sectors. What you're trying to do is reduce risk. So if you're looking at all your money, so you have money in your TFSA, your RRSP, you think you're diversified and you have all different types of investments, your entire portfolio shouldn't all go up at the same time. It also shouldn't all go down at the same time. The idea of diversification is that, let's say some of your portfolio isn't doing well because the sector isn't doing well. It's okay because another sector is going to do well. So again, the idea of diversification is that when you look at all your money and all your investments, everything doesn't all go up and everything doesn't all go down. You're not putting all your eggs in one basket. Investment funds, mutual funds, ETFs are great for that. But again, it boils down to the mutual fund, segregated fund, or ETF that you're invested in to know if you're actually diversified. I know sometimes you might read online that ETFs are the best. Like mutual funds, there are thousands of different types of ETFs. Some are a lot riskier than others. So you have to know what you're invested in to know if it's a risky investment, if it's diversified as a fund. You're allowed to take risk as long as you understand that it's a risk. So you want to make sure when you take a look at your entire portfolio that your investments are doing well and pretty diversified, not all eggs in one basket. Next, we have risk tolerance. So again, this is one of those terms that I tell clients to take with a grain of salt. When I work with clients, I do a lot of teaching. If you go to the bank, for example, or if you go to some advisors who just want the business, anytime you invest money, there is a risk profile questionnaire that you'll need to complete. And on that risk profile questionnaire, it could be anywhere between 10 to 20 questions long. They're asking you questions that are related to your risk tolerance. And depending on how you answer those questions, you may or may not be allowed to go with the investments that you want. Okay, so risk tolerance is basically the idea that the longer the time horizon, the more risk you could take on your investments. Shorter the time horizon, the less likely that you could take a risk because you're going to need the money in the short period of time. Risk tolerance means that you probably won't take it. When you have a high level of risk tolerance, then you could deal with the fluctuations of the market and you could potentially go with investments that are higher risk. But if you have a low risk tolerance, then you can't take that risk because you can't stomach it. A lot of risk tolerance and how we feel has to do with education. So the majority of my clientele, when they come to me, no matter what their income level, no matter how much money they have saved up, when someone tells me that they have zero tolerance for risk, they don't want to lose any money and they're scared, a lot of it has to do with education. And when I sit down with clients and I educate them, okay, like this is what a medium term risk is, this is what a higher term risk is. Once they get that education, all of a sudden their risk tolerance increases. And the reason why I do that is because if you live your entire life saying that you cannot tolerate any risk and nobody explains to you what risk is and what exactly are risky investments, then all you're doing when you're putting money aside is working to put money aside. You are not allowing your money to grow and work for you. Investing is taking money that you work for, that you exchange time for money for. Investing is taking that money, putting it aside, and investing it so it grows over time. And you really see this when you reach retirement. I see this in retirement portfolios when I take a look at what a client has, and I see it, we're approaching age 65, and I see that they've been squirreling money away, but they haven't invested their money, and I'm literally looking at the money that they've put aside every paycheck. There's no growth. So that money hasn't even kept up with inflation, versus someone else who has invested over time. So they're saving, they're investing, now they're approaching retirement. The cushion is much bigger, and they will have a more comfortable retirement versus the one who squirrels money away, not investing the money. So when it comes to risk tolerance, I spend a lot of time educating people, and I do this because if you don't learn how to take some risk, and I'm not saying dive completely in, if you don't learn how to take some risk, then when you reach age 65, even if you've done all the right things by putting money aside, all you're looking at is the very money that you've put aside every paycheck, and you're not allowing your money to work for you. So if you're someone who's risk averse and doesn't want to take any risk, take the time you could sit with me, you could sit with someone else that you trust to educate yourself on risk tolerance and risk levels and what exactly are riskier investments. Next, we have the bull market. So there's the bull market and there's the bear market. So bull market is basically what we're going through right now and have been going through since 2022, I guess since last summer when interest rates started coming down. A bull market is when market prices, so companies, the stock market is going up and still expected to rise. In a bull market, investors are happy, people are optimistic, the economy is happy, everything's good. So that's what we're going through right now. Think of a bull market as a strong market. People are earning money, investors are making money, they're getting their profits, they're getting their returns. Compare that to the bear market. Bears, as big and cuddly as they are, they're weaker. A bear market is when share prices in the stock market are falling and expected to fall. People are worried about the economy. They might be worried about a recession. Investors are a little bit more careful with their money. Some of them might start pulling out because they're scared of what happens. They tend to take less risk. This is, if you want to compare a bull and a bear market, right now we're in a bull market. A bear market, you could take 2022 as an example of a bear market, the beginning of COVID, was also an example of a bear market. A lot of uncertainty. People were worried. I remember at the beginning of COVID, there was this fear that we'd run out of money here in Canada. And I personally know people who went to bank machines and started withdrawing all their cash because they thought they'd be in a situation where banks wouldn't allow withdrawals. So that's the kind of attitude that regular people or people have when it's a bear market. When it's a bull market, people have their money and they're ready to invest. Tell me where to place this money. They're optimistic. They want to make money. Next, we have portfolio. So a portfolio is basically everything that you have, all your investments across the board. So if you take a look at when I meet clients for the first time, one of the first questions I ask if we're doing, let's say, an investment overview is, where is all your money? Tell me all the money you have, where it is, and how it's invested. Your portfolio is a collection of all the investments you own, whether it's stocks, whether it's bonds, whether it's real estate, all your assets, where are they? And there are rules on how it's important to, if you're working with an advisor, it's important for your advisor to know what you have as money, even if it's not with them. So when I work with clients who have some of their investments with me, I always do an overview that includes, let's say, your work group RRSP. Even though your work RRSP has nothing to do with me and I'm not the advisor on the account, it's important for me to know, because if I am working on your retirement plan, well, your group RRSP is part of that retirement plan, even if I'm not the advisor on it. So your entire portfolio is everything that you own. And again, if you're working with an advisor, it's important that your advisor knows about other money that might not be under their umbrella. Next, we have capital gains. Not so fun, but it's inevitable. So capital gains is basically the profit, your return when you're selling an investment for more than you paid for. It's your profit. Here in Canada, we have registered accounts that are available that protect you or have certain fiscal advantages if you place your money in those accounts. So the most common registered accounts in Canada are the tax-free savings account, which is the TFSA. We also have the registered retirement savings plan, or RSP. There's the registered education savings plan, so RESP for children. There's a registered disability savings plan if you have children, or maybe you yourself. If you receive the disability tax credit, you're eligible to open an RDSP. And those are the most common ones. There are other ones as well. First home savings account, which became available last year. These are all considered registered accounts. What does it mean to have a registered account? It means that they have specific tax consequences or advantages when you place money in them. So as a general rule of thumb, if you place money in a non-registered account, then any gains that you earn, any profits that you earn, are considered capital gains. And depending on how much those gains are, you're subject to a capital gains tax. If you have that money in a non-registered account and there are losses, so you lose money, let's say you invest that money and you lose it, you can offset any gains that you have with those losses. You cannot do that with a registered account. Registered accounts have specific tax advantages, if you want to call them, or tax rules, versus non-registered accounts, which basically follows the capital gains tax rules. And I always say, when it comes to non-registered accounts, that's something I could help with in conjunction with your accountant, because again, it's important for your financial advisor, to know how much you have in non-registered accounts and what the gains are versus the in registered accounts versus the registered accounts. It's important to know for your entire investment or retirement planning. Next, we have volatility, sort of related to risk tolerance. So volatility is basically how much the price of any investment goes up and down. How volatile is it? When an investment is riskier, it looks more like a roller coaster when you're taking a look at the value of the investment. High volatility basically means that the price can change in a short period of time. An example of volatile investments are a lot of the companies that are listed on the NASDAQ. The NASDAQ lists tech companies. The tech sector is very volatile. Even though it's doing really, really well, we see the gains, but there are a lot of companies listed on the NASDAQ that are much more volatile than, let's say, the Amazons and the Teslas and the Nvidias of the world. And even those could be volatile from one day to the next. Volatility is important to know when you're doing an overview of your investments, and you're taking a look at your time horizon. How much time do you have until you need to start withdrawing this money? Can you afford to be volatile? How risky is it for you to invest in volatile investments? Doesn't mean stay away from them. It means understanding that your investment, even though it's doing well today, at this time tomorrow could be a different story. And can you stomach that volatility in your portfolio? Next, we have liquidity. So liquidity is basically how easy is it for you to get your hands on that actual money. Real estate is not liquid. So I deal with a lot of real estate investors, and real estate investors often have the same mentality. Every last penny that I have goes into real estate. Real estate is fine, but it's not liquid. You cannot take a brick from a brick and mortar from a real estate property and exchange it for money. In order to get any liquidity, you would have to have a line of credit or refinance the property in order to get money out. Liquidity is basically, can you take this out as cash? And is it that easy? So most investments are pretty liquid. What's not liquid would be a locked-in GIC. What's not liquid, because you have to wait until a non-redeemable GIC, because you have to wait until the end of the term in order to access it. Another example of an investment that's not liquid is a locked-in retirement account or a locked-in pension plan. You have no choice but to wait until age 65 to access it. Anything else, tax-free savings account. If you needed money, you could just make a withdrawal. Even our RSPs, even though they are for retirement and you're supposed to wait until age 65 to withdraw the money, unless it's locked in, you can take money out of your RRSP. There's just a withholding tax that will be kept when you make the withdrawal, but it's still technically liquid. Investments in general that you do that you hold with an advisor or through a self-directed platform, in general, they're liquid. You just sell the shares, or you make a redemption, and within a few days you have access to money. Next, we have compound interest. So to understand compound interest, I'm going to explain what simple interest is first. So simple interest is basically your return on your capital. Simple interest is, let's say I have $100 and I lock it into some investment and it earns 10% in the next year. So a year from now, that same $100 that I started off today, if it earns 10%, a year from now, I'm going to have $110. Now, compound interest is when we go another year and let's say the rate of return is 10%. That 10% is not calculated on the initial $100. It's now calculated on the 100 plus the $10 that I earned a year from now. So it's interest on top of interest. The longer you hold an investment, the more the effect of compound interest, you'll see it more because it snowballs. It's basically when the interest is added on top of the principal, as well as the interest on top of the principal. And as the years go by and as your investment grows, you're going to see it snowball. This is the real definition of your money working for you. That's why it's super important to start putting money aside and investing your money as soon as possible. If you haven't done it, if let's say you're only saving but not investing, do it as quickly as you can, because the longer you hold this money, especially if you're talking about something like retirement funds, like saving for retirement, the earlier you start, the faster the effect of compound interest will work, which is basically interest on top of interest, which is what you want. Because when you retire and you look at your portfolio for retirement, you don't want to see just the money that you've squirreled aside. You want to see the money you've squirreled aside, plus the interest growing on the money you've squirreled aside, plus the interest on top of interest. That's the definition of your money working for you. Dollar cost averaging. I don't know if any of you have heard this term, but the concept of dollar cost averaging is basically putting money aside in regular intervals and not trying to time the market. So this does two things. Number one, it creates that habit of putting money aside. And the second thing it does is that you get to invest at both highs and lows in the market. So everybody wants to invest their money. Let's say you have a lump sum. Everybody wants to invest their money at the worst time so that they increase their chances of getting a high profit. It's hard to time the market. And it's hard to time the market when you don't have a lot of money. Nobody ever knows when we've reached rock bottom. So let's pretend tomorrow we wake up and we look at the markets and the markets are doing horrible. And I have a lump sum. Now I might say to myself, you know what? I'm going to wait. I'm going to wait because I know it's going to go down. I want to make sure to buy those stocks or invest in the markets when they're low. But I don't know when they're going to reach the low point in the short period of time. So I might decide, listen, we're Tuesday, tomorrow's Wednesday. Friday comes around and I see the markets keep dipping. I take my lump sum, I invest it on Friday. Well, guess what? Tuesday comes along and it dips even more. I've missed the mark. So dollar cost averaging, what it does is that it eliminates that guessing game altogether if you invest in regular intervals. So this idea of putting money aside every paycheck or once a month or whatever it is that works for you, you are getting in over the course of your entire investment career, your investment journey. You're getting in at both highs and lows of the markets, and markets always balance out. So yes, right now we're in the high. So some people will tell you don't invest right now, wait for markets to come down low. When is that? Nobody knows when that is. But if you're consistently investing, you are going to take advantage of both the highs and the lows, and it's thoughtless. Next thing you know, you're 35 years old and all of a sudden you wake up and you're 65, and all these years, all these 30 years, you've just been investing your money in it and it's growing, and you're not even thinking about, the time back when you were 35 that you missed the mark by a day. Dollar cost averaging, it's the average of basically what you're invested in over time. And it creates the habit, and you also get in the highs and the lows of the market. Question, if you wanted to invest in Tesla, Amazon, and Nvidia, what would I need to do? So individual stocks, I do not deal with individual stocks. I work with investment funds. So some of the investment funds that I work with do include those stocks. But if you wanted to buy in shares of individual stocks, you would have to create an account on a self-directed platform. You could do this with either your bank. There's also Wealthsimple or Questrade. So dollar cost averaging. And the last term that I wanted to cover was inflation. Inflation has been the buzzword over the last few years. Why? Because inflation has been really bad, but there's some good news. So what is inflation? Inflation is basically the rate at which a basket of goods and services goes up or down. So it's basically the increase or decrease of your purchasing power. So in Canada, inflation is measured with the Consumer Price Index. And once a month, the Bank of Canada, our central bank, releases those numbers. So as of right now, and I checked before I got on here, as of right now, our inflation here rate in Canada here is 1.6%. So what does that mean? So the last inflation numbers were released in October, and October's numbers were for September. So when October's numbers were released for September, what it means is that the consumer price index calculates the difference in price from a basket of different goods and services that we all use. And you could go to the Bank of Canada's website and see what those specific basket of goods and services are. But it's comparing the price from September 2023 to September 2024. And it does this every month. So every month, the consumer price index tracks if that same basket of goods, so that's what's steady, has the price of this basket of goods and services gone up or down from this time last year. So September 2024, our inflation rate was 1.6%, which is perfect. Inflation, when we work with inflation numbers in financial services and accounting and economics, the target is 2%. So every year we kind of expect the cost of life, goods, everything that we pay for to go up 2% year over year. That's always a target. What happened over the last few years is because of COVID, rising interest rates, inflation went through the roof. I believe the highest we went was close to 8%. I don't remember if we hit 8%, but it was somewhere around there. If you go to Europe, if you look back in Europe during the same time, they were close to the 10%. So countries' inflation rates vary. Even though we share a border with the US, what happens here might not necessarily happen in the US and vice versa. For example, we started dropping our rates here in Canada before the US did. Yes, we kind of look at each other because we do a lot of trade between here and the US. Yes, we look at each other to make decisions, but it's not the final deciding factor. There are a lot of factors that come into play, but inflation is measured using the CPI index, the consumer price index, from 1 year to the next, month to month. So the next CPI announcement is going to be soon. Hold on. It's actually going to be next week, November the 19th. So November the 19th, when the Bank of Canada announces its inflation numbers, what they're doing is comparing prices from October 2023 to October 2024. Why are we always a month later? Is because you need to have time to tabulate all the numbers, all the data, in order to give an accurate amount. So the inflation numbers are released every month by the Bank of Canada, and they're comparing the previous month to that month the previous year. Target is 2%. If you look over time, over the last 20-ish years, I think minus the last few years, let's say pre-COVID, so pre-COVID, for the 20 years prior to that, our inflation has pretty much always been below 2%, except for maybe a small handful of times. So we've been pretty even keel. I think in general, inflation has gone down. I know some of us don't feel that it is, but according to statistics, according to CPI, according to what the government uses as stats to determine if inflation is going up and down, our inflation rate has stabilized because we've reached under the 2% mark. I'm just going in the chat. Am I planning on having a session about risk tolerance in the future? Yes, I am. And I'm actually, I didn't do this last year, but I don't know why, but I'm planning on doing it this year, maybe not in December, but in January when I focus a lot on retirement planning. But what I do is I go over a risk profile questionnaire. So I take a random one from any company, because all financial institutions have their own. I just take a random one and we go through the questions on the type of questions that they ask about risk, regarding risk tolerance. And like I said, risk tolerance, they say it's time horizon and what you could stomach, but a lot of it is education. So I'm going to go through that. Our RSP withdrawals are taxed if you withdraw at 61. Are you also taxed if you withdraw at 65 or 67 or 71? That's a great question. because there's a big misconception about RRSP withdrawals. So when you contribute to our RRSPs at any time before age 71, what you're doing is you're tax sheltering any growth. So your RRSP is an envelope, you put money inside and you're investing it. So it's growing, it's growing, it's growing. It's tax sheltered. Before you start taking it out, you're not paying any taxes on it. When you reach retirement, or actually at any age, before age 65, if you withdraw any money, there's a withholding tax that you need to pay. And you don't even see this when you make the withdrawal. The financial institution that you hold your RSP with, they will take that off the top. And why are you charged this? Why do you have to pay this withholding tax? It's because when you made the contribution, you received a tax deduction for it. So this is the withholding tax for withdrawing the money before time. Now, after age 65 until age 71, where at age 71, you absolutely have to roll over any RRSP money into a RIF. We'll get into that in a second. You are taxed. And how much you're taxed depends on all the other monies that you take out and is considered income. It's accumulation of everything. So I'll give you an example. Let's say all your life you've been contributing to RRSPs. Now you're age 65. At age 65, you are still working. Maybe you're working part-time. You're receiving Quebec pension plan. You're receiving old age security. And you know what? You're going to start withdrawing money from your RRSP. So you have 4 sources of income. One does not talk to the other. So your work does not communicate with Quebec pension plan, does not communicate with old age security, does not communicate with your financial institution that has your RRSP. So it is up to you, in collaboration with your financial advisor and or your accountant, to figure out how much you're going to be taxed. Because how your taxable income is 1 + 2 + 3 + 4, which gives you a number. Your work is going to be deducting income taxes for you. Anybody here who works, before you receive your paycheck, your employer takes off your deductions at source, your income taxes, but the rest, you're responsible for that. So how much you're taxed depends on how much other money you also have that's considered revenue that you haven't paid taxes on. So I hope that answers your question, Maria. It's a little bit more complicated. It's no different than someone who is working but has a part-time job, and maybe has a part-time business. One does not communicate with another. It's your responsibility, in collaboration with your accountant, maybe a financial advisor, to figure out how much you're supposed to set aside for taxes or how to offset taxes. Awesome. Okay, so that brings me to the end of this. So I went over, like I said, the last top 20 terms that you may have heard, but maybe couldn't wrap your head around. So I hope this was helpful. Next week is my last session on investing basics, because I think we're all investing out after 4 sessions. Next week, it's 4 questions to ask yourself before you start investing. So again, like every other session, I'm going to share the link. And if you're not able to attend, register anyway. You'll receive a copy of the recording by email. If there is anything I can help any of you out with, if you'd like an investment review, I'm always accessible. Please reach out. It's free. I'll take a look. We'll crunch some numbers together, and we could review if you're on track to your objectives. If you want to take a look at your retirement savings, if you're on track to retire, it's important. The earlier you start, the better. Or if you have any other questions on our ESPs as well as FHSAs, TFSAs, I'm always available. So thank you so much to everybody, and have a great night. We'll see you next week.